Yeah. Alrighty. Fantastic. Fantastic. Thank you everyone for joining us. Going to give it a few more seconds, let more people enter the room. Amazing. Really appreciate everybody here being timely, being on time. Definitely an important topic. And I'm looking forward to sharing the information with you. Just give it a few more seconds to see more people just entered. Alrighty. Welcome, everybody. Welcome. Thank you so much for joining me on this exciting, timely class about the Secure 2.0 Act. It's basically an act that is impacting retirement accounts and may have a ripple effect on your overall retirement planning. And it's pretty new. Some of the stuff we're going to be talking about has not yet even been implemented. It hasn't been implemented at all across the U.S., and some things just have not yet been implemented by the TSP specifically. But certainly these are changes to be aware of, because even if it's not implemented as of today, but it's coming down the pike, and it's just a matter of time until they go into effect. Now, before I dive into the details of the Secure 2.0 Act, let me just remind people that these webinars, they don't just happen in a vacuum. They happen because I have people who are supporting me. And if you guys know one of my supporters, you may know somebody who's a client of mine, maybe know somebody who's a member of my TSP planning service. So you could reach out to them and say thank you because they are supporting me. If you are interested in supporting me, you too could become a client. You too could become a member. And I'll even share with you guys just very quickly now, and I'll also do it at the end. There's another tier of support, a very new, very funny twist to the idea of supporting what I do. And this was actually inspired by a few meetings that I had, where after the meeting, this is somebody who they already had a financial plan. I'll give you a few examples. One of them already had a financial plan. They had worked with another advisor, but they wanted to speak to me just to, one, double check what their advisor did, and two, speak to me about federal benefits. And the meeting was, a pretty quick meeting, about a half-hour meeting. And I was able to give them feedback on the plan that their advisor had done for them. And I also gave them some pointers when it comes to federal benefits. This is somebody who didn't hire me. This is somebody who wasn't an official client, an official member. But they said to me after the meeting, they said, Stephen, I'd like to buy you lunch. Now, for those who know me, I have a very limited, restrictive diet. Very limited what I could do, very limited in places I could go when it comes to diet. But I did joke to them. I said, listen, I'm not, thank you very much, but it's quite all right. And they said, Stephen, at least let me buy you a cup of coffee. And I said, I'm not really a coffee drinker either. So they, after training them in a couple of ways, they said, what can I do for you? So I said, listen, it happens to be that I like smoothies. So if you're interested, you could always send me a gift card for a smoothie. And they said, cool, that's very, very nice. And I had also another meeting with somebody else who they came to one of my webinars. I was talking about life insurance and survivor benefits, and I pointed out to them how they may not need life insurance, they may not need survivor benefits. And that meeting cost, that meeting shouldn't say cost, that meeting saved them thousands of dollars. But again, this is somebody who was not a client, wasn't a member. And they said, Stephen, I'd love to buy you something just as a thank you. And once again, can't take me out for lunch, not a coffee drinker. So I mentioned to them the smoothie idea. And so I wanted to mention to you guys, if anybody here is not a member, is not a client of mine, but you want to support the efforts that I put forth, you want to support the webinars that I give and the content that I'm pumping out. So one way you could do that is supporting me by becoming one of my smoothie supporters. And I'll put a link in the chat box, or not in the chat box, rather in the side box. If anybody here wants to become a Smoothie supporter, basically, if you're interested in supporting the work that I do, the content that I create, the webinars that I produce, if that is something you're interested, go ahead and become a Smoothie supporter right now. You could click that button in the offer that I just published on the right side of the presentation. You can click right now, and it's just a token, a way of saying thank you. I know a few people in this class have expressed that to me, and it was their idea that inspired it. And if you guys resonate with it, so great. Nobody has to be a Smoothie supporter. I'll do these classes even if you guys don't become Smoothie supporters. But nonetheless, it's just another way for people to say thank you and that they appreciate what's the content that we're producing over here. Okay, so that was just a quick commercial. And let us now move into the content of today's webinar. There's a lot to cover. So we only have about an hour together with each other. And the Secure 2.0 has, if I said dozens, it might even have 50, headlines as far as, changes that were made. I tried to extract the ones that I felt were like the most immediately relevant to federal employees. However, don't think that it's limited to just this list over here. I have a whole list of bullet points, maybe like 12 bullet points over here. It's not limited to just these bullet points. There are many other changes coming down the pike. However, for the sake of time, I've just extracted this list of bullet points, and we're going to go through them one by one. Let's start off with the very first bullet point. The RMD age is pushed off. The RMD age is pushed off until age 73, and then it will be later pushed off to age 75. Now, for those who don't know the backdrop, so let me just catch you up a little bit. The RMD age was originally set for 70 and a half. They recently changed it. I think it was in 2019. They changed it to 72. And then the Secure 2.0 just came in, and they changed the age to 73 and then later to 75. So what does that mean? So as you guys can see on the slide, if you're going to be turning age 72 in 2023, which was meaning if you were 72 and you were supposed to take an RMD in 2023 this year, so if you're turning age 72 in 2023, you will not need to take an RMD at the age of 72. Your RMD age is now 73. 73. So again, whoever is going to be 72 in 2023, you do not have to take an RMD in 2023. Your RMD age is now 73. And it's going to be 73 up until the year 2033. In the year 2033, whoever is age 74 in 2033 will need to take an RMD at the age of 75. I know it's a little bit confusing. Just look at the language and you'll see it's pretty clear. If you turn age 62 in 2023, your RMD age is now 73. If you turn 74 in 2033, your RMD age is now 75. Pushing off the RMD age does create a couple of opportunities. So, for example, when a person retires, their income usually comes down. Not always, but usually comes down. And when their income comes down, it actually may come down enough to drop them into a lower tax bracket. That's great. If you're in a lower tax bracket, that means any income that you pull out from your traditional TSP, traditional IRA, is going to be taxed at that lower tax level until your income gets pushed into the higher bracket. So if you guys are following what I'm saying, if your income goes down in retirement and you're now, instead of being in the 24 bracket, you're going to drop down to the 22 bracket, you might be in the 22 bracket until not age 72. You might be in the 22 bracket until age 73 when those RMDs, when those mandatory distributions kick in and they force your income higher into a higher tax bracket. So what that means is you just got an extra year, or if you're going to be 75, extra 2 years, where you're going to be in a lower income bracket. Perhaps, I'm not saying this is guaranteed, but perhaps it'll be the lower income bracket. And if you're going to be in the lower income bracket for another year, another 2 years, well, you could possibly do a Roth conversion during those years where you're in a lower income bracket. The Roth conversion is usually best executed when your income has dropped you into a lower bracket. So when you retire and your income drops into a lower bracket, that lower bracket may remain until the age of 73 or 75, as opposed to going away at the age, right, at the age of 72. Okay, fine. Very, very good. Very, very good. Now, there's another application to this. The RMD age being pushed off increases, or I should say as follows. The RMD age pushed off to age 73 or 75 delays the increase in your income. Remember, the RMD is a mandatory distribution. And when those mandatory distributions kick in, your income is going to go up. When your income goes up, your Medicare premiums are going to be affected because Medicare premiums are based upon income levels. The higher your income, the higher the Medicare premiums. So if RMDs kick up your income later, instead of 72, they kick it up at 73 or 75, what that means is that your Medicare premiums will increase later, which is good, meaning I don't want your Medicare premiums increase at all, but if it does increase, I'd rather increase later rather than sooner. So the RMD age being pushed off to 73 and then to 75 gives you guys a couple more years where you'll have lower Medicare premiums if you choose to have Medicare. Now, for those who have been to a previous webinar of mine, I went at length explaining whether you even need Medicare, especially federal employees. Since you already have FEHB, you might not need Medicare. But if you chose to get Medicare, so then you could at least have your premium increase delayed to a later date. Okay, fine, very, very good. Now let's go to the next detail. The RMD penalty is reduced. So for those who were not paying attention, or those who never encountered the RMD penalty, so this might not be relevant to you. It used to be that if you did not take your mandatory distributions from your IRA, not the TSP, the TSP had a different rule, but if you did not take your mandatory distributions from your IRA, you would have to pay a penalty, and the penalty was 50% of whatever the mandatory distribution was. 50%. So, for example, if you were supposed to take an $8,000 mandatory distribution and you didn't, you'd have to pay a $4,000 penalty or $4,000 tax, in addition to having to satisfy the $8,000 mandatory distribution. So now you have to take out $12,000, and $4,000 of it goes into a tax. That was the old rule. The new rule with the Secure 2.0, the new rule is that the penalty was now reduced to 25%. So if you were supposed to get $8,000 and you didn't, the penalty, instead of being $4,000, is now $2,000. And another piece of good news is that if you satisfy the RMD within a certain window of time, so let's say, for example, you were late, but you then you remedied the RMD, you took out the RMD within a certain window of time after the deadline. And again, how much time, I don't know the details of that. That's something that needs to be ironed out. But if you took your RMD within a certain window, you would still get a penalty. But instead of the penalty being 50%, or instead of the penalty being 25%, you could actually reduce it down further to 10%. So this is good news. Anybody here who missed their RMD, which again, this probably doesn't happen too often to people, but if you did miss your RMD, instead of having to suffer a 50% penalty, now there's only a 25% penalty, and even the 25% penalty could be reduced down to 10%. Fantastic. Next, there are no more mandatory distributions from the Roth TSP. Now, this is pretty big news. For those who didn't know this, when you reach the age of 72, the prior age was 72, you would have to take a mandatory distribution from your TSP from both the traditional side and the Roth side. Now, the reason why that's surprising is because with the IRA, the mandatory distribution did not have to come from a Roth IRA. You'd have to take a mandatory distribution from a traditional IRA, but you didn't have to take a mandatory distribution from a Roth IRA. So it was quite weird that the TSP, or rather that the IRS, mandated a mandatory distribution from your Roth TSP, but they didn't require a mandatory distribution from a Roth IRA. Why the discrepancy? Why would a Roth TSP be worse than a Roth IRA? So now the big news is that you're no longer forced to take a mandatory distribution from your Roth TSP. Okay, that is big stuff. This doesn't go into effect until 2024. Okay. But in 2024, you will not be required to take mandatory distributions from your Roth TSP. That's big stuff. And by the way, the reason why that's big stuff is because one of the motivations for people to take their money out of the TSP, one of their motivations, there are a few motivations, but one of the motivations for people to take money out of their TSP and roll into an IRA was this Roth mandatory distribution. People would look at the Roth TSP, which had a mandatory distribution, and they would say, why should I keep my money in the Roth TSP with these mandatory distributions? Why don't I just roll it into a Roth IRA? And then I won't have to worry about these mandatory distributions. So people would roll their Roth TSP into a Roth IRA. Now you don't have to roll your TSP into a Roth IRA because of the mandatory distribution. Now there's no mandatory distribution from the Roth TSP. Now, however, that does not mean that there's no reason to roll a TSP into an IRA. In fact, in one of my previous webinars, I was explaining some of the differences between the TSP and an IRA. And if anybody's interested, you could read, I have an article about this subject. What are the differences between the TSP and an IRA? So if you go to my website, stephenzelcer.com, you could check out one of my blog posts, is the 14 differences between TSP and IRA. So now I have to go update that slide. That article, excuse me. And now I guess it's not going to be 14 differences. Now there's going to be 13 differences. Okay, fantastic. Let's go a little bit further over here. Agency TSP matching can go into the Roth TSP. This is also pretty substantial. Now, the TSP hasn't acted upon this, so right now it has not gotten into effect. I'm not sure when the TSP will act upon it, so I'm not sure exactly when it will go into effect. But just so you guys know that up until now, when you made a 5% contribution to your TSP, you get an agency match. So basically, you did 5% and the agency would match 5%. The agency match, the 5% agency match, would always go into the traditional TSP. By law, there was no way for it to go to the Roth TSP. It had to go into the traditional TSP. That was just the law. There was nothing you could do about it. Well, now the new Secure 2.0 rules allow the agency match to go into the Roth TSP. So that means you could actually specify to the agency where you want their matching dollars to go. Do you want it to go into the traditional TSP? Do you want it to go into the Roth TSP? If you choose the agency match to go into the Roth TSP, just be aware that's going to be taxable income in the year they put it into your Roth TSP. So, for example, let's say in the year 2024, they implement this. Let's just pretend. And you decide to make your 5% match go into the Roth TSP, the match specifically, okay, the matching dollars. So let's just say they put $5,000 into your Roth TSP. Well, guess what? That's $5,000 of additional income that you're going to have to declare in 2024. So that's going to be taxable income in 2024. Okay. Now, there's another specific detail about this, about the match going to the Roth, which is that there cannot be a vesting period on this money, which makes a lot of sense, by the way, because if you think about it, if you're paying taxes on it right away and they could wrest it away from you if you did not vest in the account, so then why did you pay taxes in it? So the reason why I'm saying this is because you guys get a match and you are vested in your match right away. But there is something called the agency automatic 1%. Part of the agency contribution to your TSP is not a match. They do it regardless of whether you make contributions. So a match is when you contribute, they match it. But there was a 1% agency automatic, which they would put in even if you did nothing. That's not a match. So that 1% automatic, that had a vesting schedule. Okay, it's a 3-year vesting schedule, and the 3-year vesting schedule is it means that you're not going to be paying taxes on that money right away. So I don't know if this TSP matching going through Roth will apply to the 1% automatic, because the 1% automatic has a vesting schedule, and this new rule, the Secure 2.0, says that the agency matching cannot be subject to a vesting schedule. Okay, so just be aware that if you guys steer your TSP contributions if you steer your agency contributions into the Roth TSP, that will impact the match, but it may not impact the agency automatic 1%. Fantastic. Let's go a little bit further over here. Increased catch-up contribution. So the catch-up contribution this year, $7,500. They are planning on increasing it to $10,000. But there is a major, major caveat over here. Okay. The major caveat is that this increase only applies to people between the ages of 60 and 63. So basically, you have to be age 60, 61, 62, 63 in order to get this $10,000 catch-up limit, okay? If you are under the age of 60 or over the age of 63, meaning 64 or beyond, so then you're not going to get the $10,000, which is very, very strange. What a weird little pocket of people that they benefited. And the TSP has not yet provided guidance on this, so I can't really say anything more definitive, but just be aware that it's something that is coming down the pike. Fantastic, fantastic. Next, IRA catch-up contributions are adjusted for inflation. So this is not TSP specific. This is actually for an IRA. It used to be that the IRA catch-up contribution limit was $500. They recently increased it to $1,000, but they never attached it to inflation. That means they never linked it to inflation, meaning that it was $1,000 and it just sat there at $1,000 for a long period of time. I think it was actually sitting at $1,000 since about 2006 or 2008. It was just remaining at $1,000. Nobody increased it. So now it's going to be adjusted for inflation. It's expected to start in 2024. And when it starts in 2024, it's going to start at $1,200. So the catch-up contribution will be $1,200. And it's supposed to increase every year with increments of $100. That's what's supposed to happen. And again, it's not going to happen this year. It's scheduled to happen in 2024. And this, again, is not a TSP thing. This is an IRA thing. Next. Now, this is some bad news. Anybody who's making and anyone who's earning an income of $145,000 in a year, if they choose to do catch-up contributions, which they don't have to if they don't want to, but if they choose to do catch-up contributions, it looks like those catch-up contributions will have to go into a Roth IRA or a Roth TSP. Okay, so if somebody is earning above 145, be prepared. Again, this is not something that has been implemented yet, but this is definitely coming down the pike, and we'll see what's going to be with the TSP. But if somebody has an earned income of $145,000 or higher, if you were to choose to do catch-up contributions, those catch-up contributions will have to go into the Roth TSP or Roth IRA. Okay, just keep that in mind. Again, I don't have anything definitive to say about this, but keep your ears open because this is coming down the pike. Next, so this is something that a lot of people have brought up to me, and they thought it was the best thing since sliced bread. And I agree that it's good, but it's not as impressive as it first sounds. So this new rule was allowing 529 money to be rolled into a Roth IRA. Okay, and the reason why that was so exciting to people is because there are people funding 529 plans, but they're asking themselves, Stephen, my kid may not go to college, or they may get a scholarship to college. So if my kid doesn't go to college, or if they get a scholarship, then I'm going to have all this money that I put into a 529 plan, but I no longer need it for college. And if I don't use it for educational purposes, I'm going to end up paying a 10% penalty on the growth of that money. So people were very, very bothered about putting this money into a 529, thinking that they're not going to use this money. What happens if I have leftover money? I'm just going to have to pay a 10% penalty. So now the new rule is that you're allowed to roll your unused 529 money from the 529 into a Roth IRA. Now that is big news. That is big news because people were saying, wow, Stephen, so if I have like $100,000 left over, I could roll $100,000 into a Roth IRA. Wow, that sounds amazing. Okay, so first of all, it's not as amazing as it sounds, okay? It's good. Don't get me wrong. It's something. It's better than nothing. It's better than nothing. But let me show you not to get too excited, okay? First of all, the Roth IRA that receives the 529 money must be in the name of the beneficiary of the 529 plan. So meaning you may have a Roth IRA for yourself, and the 529 plan is the beneficiary is your child. So you cannot roll the 529 money that has your child as the beneficiary into your Roth IRA. It'll have to be put into their Roth IRA. Now, the truth is you can actually get around that as well, because you are able to change the beneficiary on 529 plans. So you could actually go into the 529 plan and actually change the beneficiary from the child to yourself. And then you can roll it into your Roth IRA. So that's a workaround. There's a few more wrinkles. The 529 plan must be maintained for 15 years or longer, meaning if you had a 529 plan for 1 year, don't think you're going to be able to outsmart the system, put money into the 529 and then roll it into a Roth IRA. No. That's not happening. Okay. The plan must be in effect for 15 years. And by the way, listen to this. As I just said a second ago, you could change the beneficiary on the 529. You could change it from your child to yourself. That's no problem. What I don't know the answer to yet is, if you switch the beneficiary from your child's name to your name, does that restart the clock on the 15-year cycle? Now, my hunch is no, but I could sort of hear why it would. So I can't say anything definitive about that just yet, but just keep your ears open. Next, any contributions to the 529 within the last 5 years are not eligible for this rollover. Next, the annual limit for how much could be moved into the 529 is going to be reduced by the amount that you contributed already into your Roth IRA. So, for example, if you contribute, let's say $3,000 into a Roth IRA, and the max that you can contribute in a given year is going to be the Roth IRA limit, which is going to be $6,500. So $6,500 is what you could contribute. You had already contributed $3,000. So that means the maximum you could contribute in a given year from the 529 into the Roth is going to be the difference between the $3,000 and the $6,500. So that's basically $3,500 for that year. And last but not least, as you guys can see on this bullet point, on this slide, the maximum that you're going to be able to do it during a lifetime is $35,000. So if you have $100,000 left over in your 529, don't think that you're going to be able to move $100,000 from the 529 into a Roth IRA. The maximum you could do is $35,000. Now, once again, I'm not clear on something. For example, let's say I put $35,000 into my child's Roth IRA, and then I switch the beneficiary to myself. Could I then move $35,000 into my Roth IRA from the same 529 plan? I'm not sure if that's going to be feasible, but that's something which I don't know a definitive answer to. We have to keep our eyes and ears open to find the answers to these questions. Let's go to the next slide. I'm moving fast. I just want to make sure that I have time for questions at the end. And also, there were a lot of details that I want to make sure that I address. Okay. Public safety employees. So public safety work. So for example, if you are federal law enforcement, federal firefighter, which I wouldn't be surprised if we have a number of those on the class today. So if you have if you're in if you're a Leo, if you're a federal law enforcement officer or a federal firefighter, and you are able to retire with a public safety pension. So for those who are in those systems, you may know that you are able to retire at the age of 50 with 20 years of service. And you could also retire at any age with 25 years of service, right? I actually just had this in a class that I gave about 2 months ago. There was someone in the class, they were age 48, I believe, and they had 25 years of service. So if they're age 48, they have 25 years of service, guess what? They could retire. They could retire, okay? Now, here's the thing. They could retire, but can they access their TSP, which is one of the 3 legs of their stool? Can they access the TSP at the age of 48? So the rule was that they could access the TSP at the age of 50. That was the rule. There was an exceptional rule. Usually, in order to access the TSP, you have to be 59 and a half. Okay, that's usually the rule. However, there is something known as the age 55 rule for civilian federal employees. I'm not going to get into that right now. There's also the age 50 rule for public safety workers. They were able to access their TSP without penalty at the age of 50. But what about somebody who's age 48 and they have 25 years of service? They are eligible to retire, but it used to be that they were not eligible to access their TSP without penalty. Well, guess what? The good news is now that person, age 48, they could access their TSP without penalty. And when I say age 48, the truth is it's any age. So long as you are separating with 25 years of service and you're a public safety worker, and so you're eligible to retire with an immediate pension at 25 years of service, you will be able to access your TSP without penalty at that age, whether it's 48, 46, whatever your age may be, 45, whatever the age may be. Okay, fantastic. You don't have to be age 50 anymore. Amazing, amazing. Let's go a little bit further. This is actually very interesting. Public safety workers can exclude $3,000 of FEHB premiums from their taxable income. Okay, so again, public safety workers, that's going to be the law enforcement or the firefighters. So if you guys are getting a pension from the federal government and you're having FEHB premiums withheld from that pension, which you probably will, so $3,000 of those FEHB premiums will now be excluded from your taxable income. That's a great perk. That's a great perk. And I wish that applied to civilian federal employees as well. That would be a sweet deal for everybody. But it doesn't apply to civilian federal employees. It just applies to the public safety workers. So let me just clarify what I'm saying over here. Right now, while you guys are employed, whoever has FEHB while they're employed, your FEHB premiums are tax deductible now while you are employed. But once you retire, your FEHB premiums are no longer tax deductible. They no longer lower your taxable income. This new rule allows for public safety workers to exclude $3,000 of the FEHB premiums in retirement. Okay, so that's a new perk. It doesn't apply to everybody. It applies to public safety workers. And let's see, maybe in the future, that'll be extended to civilian federal employees as well. Okay, let's go one more detail over here. The ABLE accounts for people disabled between the age of 26 and 46. So for those who don't know, if you had let's say a child that was disabled before the age of 26, you were able to set aside money in what's called an ABLE account. Okay, it's an account with benefits that are available specific to disabled people. However, that was only for somebody who was disabled prior to the age of 26. If somebody got disabled at the age of 27, they would not be able to fund one of these ABLE accounts. They would not be able to reap the benefits of these ABLE accounts. And that's if they got disabled at the age of 27. Now, the new law, Secure 2.0, comes in and says as follows. Even if the disability happened after 26, so long as it happened before the age of 46, you're fine. You are able to contribute to these ABLE accounts. So that means somebody who gets disabled between the age of 27 and 40, or 26 and 46, whoever gets disabled between those ages, they are now able to participate in these ABLE accounts. That's a nice benefit. So all the changes that I told you thus far were actually, for the most part, positive changes. The one change that I think maybe has a little bit of a negative impact over there is going to be the mandatory Roth catch-up contributions for people that have an income of 145,000. As I said, this, and again, I don't have TSP guidance on this, so this may or may not happen within the TSP, but the way it looks like it's going to be structured is that if somebody is making a catch-up contribution and their income is above $145,000, that catch-up contribution may have to go into the Roth, which means it's going to be taxable that year. So that is, on the list of things we spoke about today, that is probably a negative. But all the other categories I would consider a positive. Now, I want to open the floor up to some questions. But before I go to the questions, I do want to mention to you guys that I do offer a complimentary consultation. If anybody here is interested in speaking with me about financial planning, about federal benefits, about Secure 2.0, and maybe an expanded conversation about this. So if you're interested, we can have a complimentary consultation. It happens to be that my schedule is a little bit choppy, but you could definitely meet with, if it's not with me, you can meet with a member of my team. Anybody who's interested in requesting that complimentary meeting with either me or one of the members of my team, the way you request that That meeting is in the chat, but is in the sidebar right over there. There's a button that I just published on the side, meet with Stephen. It's either meet with me or meet with one of the members of my team. So if anybody here is interested in a complimentary session, you could click on that button right now, and it'll take you to a page where you could request the consultation, and then someone from my office will reach out and schedule that consultation, again, either with me if my schedule permits, or with a member of my team. Okay, so that is a complimentary session. Again, that doesn't cost anything. It's just one of the things that I do for federal employees. I give these webinars. I give complimentary sessions, and I also do other things. But as far as the other things are concerned, you can look at my website for my blog posts. You could come to one of my future seminars, or, as I said, you could also buy me a smoothie. Okay, as I mentioned, this is a new way of saying thank you for anybody who's interested in the classes, in the webinars that I present, and also the blog posts that I put out, the articles that I write. If you're interested, you don't have to do this. This is totally optional, but it's just another way that people could say thank you for the content that's being put out. Totally optional, not required, but is definitely approved. And certainly I'm not a coffee drinker, and I have a very limited diet, so smoothie is probably the one thing that it could do. And this is the type of thing which you could be a smoothie supporter. It's an ongoing thing. So that means that if you want to buy me a smoothie for every month that I put out content, so every month I'm putting out a webinar, every month I'm putting out articles, if you're interested in supporting what I do, you could become a smoothie supporter right now by clicking that link, and it takes you to that page. Fantastic. Okay, that's for anybody who wants to support my smoothie efforts. Okay, great. Now, with that being said, I do want to open the floor to some questions. We have some time for some questions. Okay, I have a question in the chat box. What year do the Trump tax cuts expire? So the Trump tax cuts are scheduled to expire at the end of 2025, which means that starting in 2026, your income in 2026 and beyond, the old tax brackets will return. So let me put that in perspective. Right now, many of you are in the 24% tax bracket on the federal level. When the old brackets kick back in, you will see that you're not going to be in the 24 level. You're going to be in the 28 level. Okay, so you're going to go from 24 to 28, and that is scheduled to happen in the year 2026. Okay, let's see some more questions. Randall has a question. A bit off the subject. Given current stock market performance, would you advise moving some funds to the international fund since it is performing better? So, Randy, the international fund happens to be performing better this year, but it's very hard for me to justify putting your money into the I fund just because it has shown a temporary blip of good performance. Just so you know, historically speaking, the I fund for the past 30 years has done half of what the C and S funds have done. Half. And it's more risk. So you're taking more risk to get half the performance. Now, will they do better this year for the remainder of the year? I have no clue. But if you're asking me, if I have a choice to hire, one of two portfolios, I could choose the portfolio that has consistently done the performance that I like with less risk, or I could hire the portfolio that has consistently done half of what I like with more risk. If I had to choose between two portfolios, one is the C and S funds, and the other is going to be the I fund, okay, even a little bit of I fund. So I would say I don't see why there's a justification to hire the I fund into your portfolio as of yet. Now, it could be you're onto something. It could be that the I fund is turning over a new leaf, and we're going to see different performances from the I fund going forward. However, I will say that when you're investing in the I fund, you're not just investing in the American economy, you're investing outside in numerous other economies. And those other economies are governed by other governments, and not every government is business friendly. So just be aware that if you're investing in the I fund, you are exposing yourself to international governments, international governance as far as the businesses of the I fund are concerned, and also you are exposed to dollar exchange risk, or the currency exchange risk. So if the dollar gets stronger, the iPhone will go down. If the dollar gets weaker, the iPhone will get stronger. Okay. I see somebody's asking me, do I accept Venmo or Zelle payments? Right. So I don't really know how to set those up. So so thank you for asking. Dana is asking, are you conducting a class to NIST or to Commerce employees? So Dana, I don't know if that's me. I am conducting a class, but I don't think that's those dates that you're saying in May. I don't think that those are those dates. So Dana, if you are interested in me conducting a class for NIST or for Commerce, do me a favor, send me an email. My email address is stephan@stephanzelcer.com. Stephan@stephanzelcer.com. Okay. Fantastic. I see I have another question in the chat box. Sydney is asking, I didn't hear, do we owe taxes on these transfers? So Sydney's probably asking about the 529 to the Roth transfer. So Sydney, remember in the 529, there's two parts of the 529 balance. There's the principal, which you've already paid the taxes on, and then there's the growth, which has not been paid taxes. So the principal, you're not going to owe taxes on. The Roth, the growth portion, I actually didn't pay attention to that detail, whether or not that portion is going to be free of taxation. That sounds pretty good if it's going to be free of taxation, but it does make sense because maybe what they're allowing you to do is they're allowing you to recreate a Roth contribution. So Sydney, I cannot say definitively, but if you're asking me to guess, what I think they're trying to accomplish is they're trying to recharacterize your 529 contribution as a Roth contribution. And just as Roth, the principal is post-tax and the growth is tax-free, it could very well be with the 529, the principal is post-tax and the Roth, they may allow you to transfer tax-free. Okay, I see David is asking, what years will the TSP 145 income limit take effect? So David, I don't know yet. Okay, I'm sorry, I don't have definitive guidance from the TSP. And I see Dave is asking, is the 145 pre or post TSP deductions? Dave, it's a great question. I don't have the details about that. I think it has to do with your employer compensation. So you're saying I could lower my employer compensation with traditional contributions. It's a great question, Dave. I do not have the clarity. I don't have TSP guidance on it yet. So wait and see. I'm sorry to tease you with the material, but just keep your ears open. Keep your ears open, and we'll see what happens. I see that someone's asked me a private question. If someone's asking, if the Trump tax cuts are expiring, would it make sense to do a Roth conversion before then? Yes, that is definitely something I speak about in my classes, that because the taxes, when the Trump tax cuts expire, your tax brackets are going to go up. So you actually might benefit from doing some conversions now before the tax brackets go up in 2026. Yes, that does make a lot of sense. Okay, and then somebody's asked me to repost the offer for the meeting. So let me post that offer for the meeting. If anybody here is interested in that compounded consult, here you go. There's the offer in the chat box. There is the offer in the chat box. And if anybody here is interested in getting me a smoothie, I'll post that link in the chat box as well. Here it comes in the chat box. 1, 2, 3. Boom. Oh, I'm sorry. I posted it to the wrong box. Excuse me. Here it comes. Here it comes. 1, 2, 3. Boom. Okay. Andy's asking, will I make my slides available? Andy, I'm happy to. Do me a favor. Send me an email. And this way I know I can respond to you. Okay, I want to thank you all for joining me on today's class, and I hope that it benefited you. And in general, I hope my classes, my webinars, and my articles are a benefit to you. And if I could be a resource to you guys going forward into the future, please let me know. You can always request that complimentary consult. And if you guys just want to say thank you, you know how to do that. Thank you very much. Have an amazing day. Keep in touch. All the best to everybody. All the best, everybody.